Yes, guys and girls, welcome back to another BMO video. It is Tuesday, the 3rd of Feb. Now, let's quickly have a little look at the calendar. Obviously, wait, let me just quickly filter. There we go, and we shall share. So obviously, yeah, we spoke about the RBA last week. They did hike as largely expected, and obviously that is pretty good for the AED. So if you were long AED last week, then obviously that would have helped you out quite a bit. But nevertheless, let's have a little look as to what we got. Now, obviously there are government shutdown again, and some of this data here, as you can see, will be impacted by a shutdown. Tentative subjects are to delay revisions or cancellation. So whenever it says tentative in the US, it generally means that it's probably going to get delayed further and further. Nevertheless, we were meant to have NFP this week, but of course, because it's the shutdown, we don't have that. So it's a bit unfortunate. But let's see what we've had. Now, this, as you can see, yesterday morning, pretty dead, nothing really. ISO manufacturing was actually pretty decent. We did go back into expansion after about, I think it was last year, it was when it was March 2025 was the last positive month. And then after that, it was pretty negative, and then it finally went into positive. So that was somewhat of a good sign. And I did see a little bit of dollar strength on the back of that. Then, obviously, apart from that, rest of Monday was pretty quiet. Then today, you can see the RBA, they hiked as largely expected, but we'll have a little look into were they hawkish, were they dovish, etc. But as you know, a good way to look at it is just basically look at how the AUD reacted post-meeting. So basically, how has it traded after the meeting? And it's been pretty good. So clearly something was said quite well, but we'll have a little look into it a little bit later. Then we have employment data from New Zealand. Again, it will be pretty important because some people are now starting to talk about maybe going along the NZD on the back of economic rebound. So what we basically need to do, and we were still looking at some New Zealand dollar longs anyway, so that's kind of helping us out a bit. But nevertheless, it is expected to do okay, pretty decent, I guess. Better than last quarter anyway, so that's somewhat okay. Unemployment rate is expected to stay the same though, so let's just watch that figure. Then Wednesday, tomorrow we have core CPI from Europe, and just double checking. Okay, that's expected to stay the same. They shouldn't need to do anything then, basically keep rates as they are. ADP, I'm not sure if this is going to be delayed. I don't think it is. If it's not done by the BLS, then I don't think the data is delayed. So because you can see it's done by automatic data processing Inc., it probably won't get delayed. But if it's done by the BLS, so stuff like NFP, unemployment rate, then they should be delayed. ISM manufacturing, PMIs. So obviously this is ISM. So that's a company, you got S&P Global, so that shouldn't get delayed as well. And then a rest of tomorrow is looking a little bit quiet. Then Thursday, so what do we have? Nothing really until the afternoon, where the BOE is expected to hold rates, as you can see. But what we need to be focusing on is going to be the skews, right? How many people votes for cuts and how many votes for holds. That will be seen as either hawkish or dovish based on the split. Then, of course, Bailey is speaking, so we'll just have to see what he says there. And then, not too long after, we have the ECB. So Euro GBP will be quite an interesting one on Thursday. But yeah, they are not expected to cut. I don't think anybody does expect them to cut anymore. But if that's the case, how do we trade it? Obviously, we don't trade the meetings, but we look at, what is their language? Are they hawkish? And the updates to forecasts? And then we use that as a guidance on obviously what we see in the press conference. Says tentative, Department of Labour might get delayed. So let's just see. Then the Bank of Canada, McClem, he is speaking. Where is he speaking though? Because that's important. Okay, so maybe he'll say something there. Economy and implications for monetary policy. So at an Empire Club in Canada. So let's just see if he does say anything. Bullock is also speaking, 10:30. The question is though, how different was it, after, is there going to be a major difference between what she said today versus Thursday? Probably not, but we'll see. We'll look at it anyway briefly. And then Friday, and let's see if we've got anything here. Not really until the afternoon, where we have employment data from Canada. And that's expected to stay a little bit dull. 5K, again, is not super amazing. It's basically flat growth, flat employment change on that front. And then 3 p.m. we have University of Michigan consumer sentiment. Again, I don't think it's been too big of an impactful bit of data. We only see this become really impactful when people are talking about like recessions and stuff, and then they're like, oh damn, okay, let's look at consumer sentiment to see whether or not people are expecting this or not. And that's when it becomes a bit more focal point. But if not, it doesn't really be a market driver, as you know. But apart from that, dollar has obviously traded a bit higher. And what you might notice is we've not really seen any more issues from Trump, right? And we did speak about this on Friday's breakdown about, if we don't see any more issues from Trump, you could see a bit of a pullback in the dollar. And it's kind of seen, we've seen that already. And like Friday, we spoke about that and it's kind of followed through. And I guess it's the case still. So if we do not see any more major issues from Trump, we could see a little bit more of a pullback on the USD as well. Nevertheless, euro dollar as well, we are pulling back quite nicely. Obviously, we're not going long here, but we have pulled back quite nice. And dollar yen is still pulling back. We're not selling that. Obviously, that's when we was just talking about it last week, and obviously some mentorship. But we are still pulling back, and we spoke about it last week about how, even if this was intervention, which it wasn't, but even if it was hypothetically, we need fundamentals to be in supportive of stronger yen, but because there is no reason for the yen to be stronger, is there? So therefore you go opposite, even though we saw a large sell-off in dollar yen or a large push in the yen. And that's why like AED yen is what we was talking about, since this, end of Jan. We saw some nice price action and it's continued, right? Because what we're doing is we are comparing who is better off than the yen, and quite a lot obviously, but you get the gist. Gold as well, we saw a huge sell-off, of course, not because of fundamentals though, largely due to positioning. So if it's due to positioning, it's not that people have gone bearish it all of a sudden, it's just that they've exited their longs, and as a result that kind of turbocharges that selling pressure as more and more people jump on board the sort of sell train or the exit train. However, fundamentals haven't changed, so it should still be supportive of upside in gold, even though we had a big sell-off. We haven't broken structure yet. This is the actual technical breaker structure, which is here, but because that lower high made the lower high here, this is all just interim 15-minute pullbacks. But yeah, that's technically, and we're not too far now, so if we can get a push and then a pullback, that would look pretty good. But you get the gist, right? What you're basically asking is fundamental supportive of going short or going long? And if it's a yes, then you remain. If not, then it's largely due to just positioning or flushing. And as a result, you can just get back in on when you see price action be in your favor. Obviously, you don't just buy for the sake of it. You want to wait for price action to tell you it's now reversing. But above that is myself on the news. Let's jump straight through onto the dollar, the pound, and the euro. So the dollar, let's have a little look. Obviously with the USD, remember what was always think opposite. And what do I mean by that? So basically think, why did the dollar sell off? So why did we sell off through this period and all through here as well? And that was largely due to this is largely driven by Trump, of course. This one, I can't really remember. I think that was, just Christmas price action. So I kind of just leave that alone. But this one definitely recently was driven purely by Trump, right? Trump and his tariffs, Trump talking about everything else. Cool. Now ask yourself, are people focusing on that right now? Basically, are you seeing news on Trump as of right now? Or have you seen news about Trump even last week? Middle of last week, for example. Have we seen news about Trump, doubling down on tariffs, doing all this about Greenland? No, I've not seen any news on that. So what people then ask is, does it still then make sense to sell the dollar based on that assumption that we was trading it originally? If it's a no, which it obviously was because there hasn't been news on it, then people pull back the dollar. But what you ask then is, okay, why, how can the dollar trade up further, essentially? And then they go back to what was driving it prior to Trump, which was obviously the data. So that's basically what we're doing with the USD right now, is we're just changing between what is driving it and then what was previously driving it. And then if something pops up, Trump suddenly doubles down again for whatever reason, then we go back to being Trump. But until then, we just focus then on the dollar, on the data that regards the dollar. Obviously, because we've seen a little bit of lockdown issues, that hasn't really been, it's a bit unfortunate. But nevertheless, I do feel like the dollar can probably pull back a little bit more. Equities as well. I think it's just going to probably stabilize a bit. But yeah, definitely for the dollar for me, maybe just a little bit more of a pullback. And then we can get into some nice sales, in my opinion. Just because, again, I don't think there's like all of the doom and gloom that was driving the dollar lower is kind of fading away. So you do have to go slightly opposite to your contrary to your view, shall we say. But I don't think it changes the overall theme for the dollar this year. I think last week we did also look at, somebody said like February is quite good for the dollar seasonally. Obviously, we don't use that as a gauge for price action, and we say, oh, we have to buy the dollar now in February. But it does kind of use it as like an extra confluence, and it does make sense when you add on the narrative of, you know, no more issues in Trump. Data is kind of stable. It's not really like doom and gloom. That does allow the dollar to pull back a little bit. And then you add on seasonality as an extra confluence. You don't use that as a pure gauge. But let's have a little look at what ING is saying, and then we'll have a little look at what other people are saying as well. But what they're saying is the delay in payrolls shouldn't derail the recovery. The dollar extended the recovery yesterday, this time with some help from strong data. The manufacturing index surged back into expansion for the first time in a year, jumping to 52.6, well above expectations. Production and new orders rose sharply. Order backlogs also moved into expansion, all pointing to a solid momentum in output ahead. We discussed yesterday how we think this week will allow the data to do the talking in FX, but the release of Friday's jobs report has now been delayed due to a partial government shutdown. JOLTS data scheduled for today has also been postponed. However, House vote on extending government funding is expected to be as early as today, and it should pass. This week's data may be published next week. Incidentally, ADP and ISM services will be published as scheduled tomorrow, because I think it's just BLS that is affected by this. So BLS releases the NFPs, the unemployment rates, these big sets of data. Our view on the jobs numbers was fairly upbeat, but the latest showdown showed in an environment where a negative story is required to push the dollar and found it definitely the case now, given rate differentials arguing for a stronger USD. Some data science can still help the USD on the margin. And that's what I was talking about earlier, right? About how just think opposite to the reason why price action was so bearish over the past couple of weeks, right? It's all about Trump. People weren't really focusing on the data or Powell. That's perfectly fine. Because that wasn't the driver. It was all about Trump. Now that's died down and faded away slightly, people can't use that as a bias anymore. They have to think, okay, what can next? They're always searching for something new. And that is not new news, is it, about Trump? So now they're going to look towards back to being the data again. Obviously, because we haven't got issues on the data, they're going to sort of gauge their bias on how has the data been during all of this issues around Trump, etc. And the data hasn't been that bad. So they're going to use that as an idea to say, okay, maybe we can slightly go long the dollar tactically, but not fundamentally. Remember, we need fundamental reasoning to go long the USD. This is more tactical. Remember, I have made education on this. It is on the website. Obviously, please watch it. And you obviously have to do some forward and also back testing. But this is more of a tactical view, isn't it? And that's, to me, what I believe is also to be the case as well. I don't think we're going to trade it all the way back up to the highs, but I do feel like we can sort of pull back a little bit more, and then maybe we can reestablish a view after that. If it goes a bit high, that's perfectly fine. You know, we'll just follow the news flow as it comes through. But for now, I'd sort of aim more towards these lows, maybe a little bit higher. I can't say 100, but who knows, right? We just have to see what is the sentiment around like sort of that 98, 600, 800 region. And then maybe we can aim for 99, 500, possibly 100. So you get the gist. What they're saying is dollar has now recovered most of its recent losses, but in our short-term valuation metrics keeps pointing to room for further USD recovery across the board. The dollar recovery had lost some steam overnight, and we think today's price action may be mostly stabilization rather than directional, which is kind of true, right? You can see today we've basically consolidated, so it's not really moved anywhere. Stable right now. And I don't think we have a big reason to go bearish the dollar, though. That's the thing. Even if we completely forget about Trump now, we have to now look at the data and Powell and the sentiment around the Fed. I don't think it's that bearish right now. And that's why we're saying, okay, maybe we can go slightly tactically long the USD. So now what you do then is you pair the dollar against those who are slightly seeing some issues in the near term. For example, like long dollar yen would make a lot of sense right now. Even though last week we spoke about probably not best to trade that, given that sentiment has shifted, we now have to shift as well. So like dollar yen longs would make sense. GU shorts would make some sense as well. Probably come a bit lower towards sort of the middle of this, a lot of imbalance there. Obviously I don't trade imbalance, but you can use that as a rough gauge as well. I'm just trying to think of other ones that could be really, really a good amount of opportunity. Euro dollar, I guess, just because of the DXY, but euro is still okay. And you can definitely trade it in the near term. but I wouldn't really hold on to it for too long, to be honest. Nevertheless, let's have a little look as to what Goldman have to say about the dollar. And what they say is, feels like old times. We expect the dollar to fall modestly this year, as strong but less exceptional US performance should weigh in the currency. But the dollar's recent decline has been anything but modest, obviously. Like last year, those policies aimed at international trade can have an outsized influence on exchange rates. However, it is notable that FX volatility has increased by a similar magnitude as it did last April, while rates and equities have not. This can itself be a reason for global investors to increase the FX hedges, which would reinforce these dynamics. They're going all like really technical now. We don't really care about that. We continue to think rate differentials and Fed policy will play a more limited role for FX for now, while some of the initial market moves are consistent with investors taking down some institutional governance risks. We think only local positioning can help the extent of moves in FX and beyond. So very, very technical, but not really saying a whole lot, to be honest with you. But you can basically just gauge it that they are bearish the dollar for this year. Now, that doesn't mean you have to sell the dollar of every opportunity, because that is more of a long-term view, isn't it? Like, that's their long-term view. That doesn't mean now you have to shift to, now let's suddenly sell the USD because Goldman's talking about it. Like, it makes sense for this year, but don't think it's tradable right now, if that makes sense. Because you obviously have tactical views and you have fundamental views, right? I would say I'm more tactical right now rather than fundamental. Goldman, I guess, is just purely going on a really big high time frame, which is perfectly fine for them, of course. Now, I just want to double check if JPM does talk about it. Obviously, they do tend to talk about the USD in some of their Euros sections. But what they say is crazy vol, must be a pain out there. This is second, so the yesterday's. Blaming the wash news, and I guess thinking about it maybe is not from a hawkish angle, but more so from the Fed independence and dollar debasement narrative, given he's an ex-board member and the choice could have been more left field. Nevertheless, whilst the amount of dollars sold last week was pretty outstanding, FX feels like it's still a second derivative to the leveraging and de-leveraging seen in commodity markets. Maybe that changes this week to some extent with plenty of central bank meetings and US data on the tap. I said on Friday that I didn't see a full reversal forthcoming, but still believe that overall, but clearly being able to stay in the game here is key. If the labor market data is weak, we'll only reinforce the administration's call for lower rates. But obviously we know that there's a partial lockdown, so we're not going to see that data. But I would agree with that. If the data does come in lower, then they are probably going to have to try and cut maybe a little bit sooner. That should pull the dollar lower. But if we're not seeing that, and we haven't seen data, and we're not going to see data anytime soon, like what ING, it could just be pushed the next week if the bill gets passed through in Congress. I think it's today, or the House, one of them. But nevertheless, if it does get passed today, they said that it probably will get released next week then, which is, it's just a week later. It's not that big of a deal, but you get the gist, right? What you now need to think about is just the data. What does the data mean? Does it allow the Fed to possibly cut by more? Does it maybe mean less? That's all we're thinking about, really. I don't think anything else here that we need to think about. No, we'll read through that when we move on to the euro. But apart from that is myself and the USD. Obviously, right now, you do have to be focusing on what is the near-term driver. And I would say the near-term driver is more stability in the US rather than outright bullish momentum. And that's why we can tactically trade it. So basically, we're not going to hold on to it for a large amount of time, but we want to be capturing the yield and the opportunity. Because if you weren't trading tactically, then you're going to have to look at other pairs that aren't tied to the USD, right? Because if that is the case, and you just want to trade, fundamentals, then you are going to have to wait a bit longer to get in a trade because you want to be selling the USD. But I don't think the time's here right now to sell the dollar, unless data tells us, obviously. But because there's not probably going to be any data, I doubt there's going to be a reason to sell the dollar. But yeah, apart from that, dollar CAD, I guess we could actually trade it a little bit higher. I'd say more so, not too high though, probably just to this next high. So you can definitely capture, maybe 100 pips, maybe slightly less, but still, nevertheless, if you can get a good risk reward, you should be pretty good. So let's start on the daily time frame. Obviously, this will be the best opportunity to buy from. Yes, that's a good daily demand zone, but is there anything in before that? And we are kind of sat in sort of this 6 to 4 hour demand zone, which is basically where we're at now. And what I want to then see is a break of structure. So I don't think we've broken structure yet. Something like that, I think. Yeah. That is technically a break of structure, but this price action doesn't look good. You can see how we came below that low. So that is technically a break of structure. And you would have probably bought at that 1 hour demand zone or this prior high. Either one would have been fine. But yeah, that reaction's not great. But nevertheless, I do feel like probably we can become a tad bit higher. Obviously, we do have, what's it, McClem, isn't it? McClem is speaking on Thursday. And we have Canadian data. So maybe we'll see how this plays based on that data. Dollar Swiss, I would say probably higher, just because risk sentiment isn't as bad as it was, a couple of weeks ago. So as a result, Swiss doesn't really have a reason to go stronger. So maybe we can tactically trade it slightly to the upside before initially going back basically towards these lows, possibly the supply zone here on the daily time frame. And then we can sort of go bearish the dollar at that point. Where we can enter from is going to be a bit tricky, I think. We have broken structure here, so that's good news. So ideally like there, obviously, because that would be like a nice sort of 61.8% retracement, maybe like a 77 or a 71, sorry. Yeah, right in between, that's fine, perfect. Is there any other ones around there? Not really. I would be watching these highs here though. Around here, these highs as well is what I'll be watching. So either here and we see a reaction, like a break of structure here, then we get on a demand zone and then a push, or we come a little bit lower towards this sort of demand zone down there, and then we go from there. Like I said, it's probably a good opportunity. Slightly long. Where we go from though is going to be tricky. I think you do have to be a bit more aggressive on the exit. So for example, something like 57,500, for example, these prior highs, and then get out. And then apart from that, the other ones I don't think is tradable right now. I don't really trade emerging markets very often. I think the last time I traded was 2 years ago. But nevertheless, yeah, that's myself in the dollar. In regards to the pound, now data-wise, let's quickly have a little look and refresh our memory, because how we've been trading the pound over the past couple of weeks has been pretty easy, because all we've basically been doing is just essentially just looking at other people, right? But because we have the BOE this week, now we do have to be a little bit more eyes on, which is, I think obviously we'll have a bit more to talk about on Friday because we would go over the BOE. But I just want to double check if there's anything here regarding the Bank of England before I look at ING. And whilst I'm here, actually, let me open up pound sterling also. Bloomberg wise seems pretty dead. Yeah, seems pretty dead. Gold after. Yeah, doesn't seem like there's anything there. Just want to see, normally they'll have like a weekly outlook for the BOE. And that's if they've done it for this week. Hopefully they have. Fingers crossed. Okay, so let's see this. Cautious Bank of England poised to keep rates on hold despite hiring weakness. Again, nobody's really expecting a cut now. Probably a little bit later on. But the way to do it is the data is going to tell you how many cuts and when they're likely to cut. The central bank will basically reaffirm that view or go against that view, right? So like, for example, if the markets are expecting 3 rate cuts because of the data, but the BOE in their meetings suggest more like 2 or 1, then there's a discrepancy there. So what we're going to either see is either the data slightly recover because let's say they are expecting in their forecast to be a little bit better, or the BOE is under evaluating it. Either one of those will happen. So how do you determine what is going to happen? Is basically just watch the data after the meeting. And that's what we're going to have to do, right? What do they say in the meeting about rate cuts? And does the data from then until the next meeting suggest rate cuts or not? So they are expecting a rate cut in March, which is fine. That's not too far away now. The bank was cautious in December despite cutting rates. And there are good reasons to think the bank's work isn't done yet, which is, we basically more cuts. Now, the bank said in December that upside risks to inflation are abating, and by March, there should be 2 rounds of data evidencing that. We still expect a cut next month, or at the very least, the probability is higher than the 20% currently assigned. Will the bank open the door to that at this week's meeting? We're not so sure. We highly doubt the bank will change its forward guidance, noting that decisions are becoming harder as rates approach neutral. And that's generally what happens because they don't want to overcut and then they're going to have to hike. What they're trying to do is like soft land the environment. They don't want to, keep rates too high for too long because that then drags growth much lower and then they're going to have to backtrack later on. So what they're going to do is just kind of take it meeting by meeting. It sounds boring at this point, but that's generally what they're going to have to do, right? Meeting by meeting, seeing what the data does, and then reacting. But the bank will open the door to that, we're not so sure. And in the press conference, Bailey, despite recent tendency to leave side with the Doves, is unlikely to explicitly talk up a March cut. The BOE isn't keen on commenting on market pricing unless it's decisively out of line with its thinking, and that isn't true right now. The mantra this week is likely to be keeping options open and let data do the talking instead. So basically, if that's the case, based on their assumption, and that's if they're right, of course, ING, the pound shouldn't really react anywhere because markets already know what's happening. If they don't really give much to work with, you're not going to have much juice to trade with. And that's what we want. We always want to be finding where the juicy trades are. How do we find where the juicy trades are? Watching where there's opportunity, identifying when there's opportunity. And that's obviously takes time because that comes with understanding context. But that's what we now need to be thinking about for the UK or for the pound in particular. So if the BOE this week doesn't stress too much about after the meeting, then probably going to have to trade the pound until like how we have been trading it over the past couple of weeks, basically just looking at other people. And then when data comes, then we can think, okay, does it now make sense for March, or does it now mean a bit later on, etc. And that's what we have to be looking at in particular. So yeah, for now, what I'm going to do is probably leave the pound alone until Thursday, because there's other trades out there, remember. If you're in trades already, basically just leave it alone. Then the BOE talks. If they say something that's new, then we'll evaluate it. If not, then we go back to what we were doing before about who's better than the UK, let's say Australia or New Zealand. So we trade GA and GN lower. Yen is a lot worse off than the UK. GJ buys. The USD might see a little bit of strength, so GU sells. So basically just follow other people for now. BOE talks, assess it, nothing new is said, go back to following other people. That's basically what I'm probably going to do for the UK. JPM, they're basically not saying anything here. Yeah, not really saying anything. Louise is saying she's not really running anything in the pound right now, but still keeping the bias to fade Euro GBP dips into lower 86. For cable, was relatively neat pivot over the past week, and that's about it. That's all they're saying, really. Obviously, they're saying similar to what ING is saying about how weak growth, a weak labor market, and stubborn prices, basically inflation. And that's been the case for a while now. So let's just see what they talk about. I mean, data next week, pretty quiet. GDP will be the only one after that. Do we have CPI? Yes, cool. So 2 weeks away is probably when the most volatility is going to come through, middle of February. Yeah, apart from that, that's myself and the pound. GA. Obviously, we're still looking to sell GA. The RBA was a little bit on the hawkish side. So overall, still looking pretty good, I would say. Yeah, I would still look for bearish price. Not the greatest of price action now. And the only region I would be watching for any sort of structural breaks would be around here. That's about it. GCAT, yeah. We were looking here initially. We did see a little bit of reaction, but it's just been very, very choppy. Now, especially nowadays, you can see those wicks are just not friendly. So we don't generally want to be trading those environments. If we've got the 1 hour or even the 4, yeah, not great. Yeah, not doesn't seem too appetizing. For example, we've not even made a new high because that didn't close there and that didn't close above this previous wick high there. So there's no highs being created for me. As a result, that's just volatility, isn't it? The wicks of volatility. Pound Swiss, so I'll leave that alone for the time being. G Swiss, I suppose you could be a bit more biased long now, just given that, the whole reason Swiss was doing so well is because gold was also doing quite well. And why was gold doing so well? Because of issues around Trump and policies. We're not seeing that much anymore. So people just basically took their profit on like gold, which sold it off. And also recently as well, we're seeing a little bit of stabilization in G-Swiss as well. So maybe we can go a little bit higher and then we can establish a view. If you want to enter a long then, G-Swiss would probably be more so. There's not much there, is there? The only region would probably be 106 and then a long. So basically around here and then a nice long. GJ, yeah, probably got a bit long. I'm not going to argue against that. So yeah, towards sort of the supply zone looks pretty decent. GN, as you know, we are bearish this. I'm just a little bit cautious though of this, but we did make similar price action not too long ago here, right? Where we basically struggled to close below the low, the wicks, as well, but price action still went a little bit lower. But I do feel like it still can probably go a bit lower. I'm just going to let the pullback do its thing. It's kind of similar to GA price action. So I'll be watching more so around 6-hour demand zone to 4-hour demand supply zone, sorry, around there. And there's also an 8-hour supply zone. So let me just extend that. There we go. Perfect. Around there would look pretty good in my opinion. And then we can see how price action reacts from there. Lastly, GU. Obviously, we'd want to be in a little bit of a sell. Let me just delete this. So we want to be a little bit of a sell, mostly because of the USD. However, price action here is ugly. On the 1 hour looks a bit, worse, right? It's not good price action to be to want to trade. So what I'm going to do then is either wait for a push low and then a pullback, or push into here and then a sell. Either one of those is what I'll be watching for now, because I don't want to try and sell it here and then it kind of goes higher and then lower. I don't want to take the risk to try and sell it, even though price action isn't telling me to sell it right now. So we don't want to guess that price action is going to reverse. We want it to basically tell us it's now reversing. So basically either a push into this supply zone or a break, close, and then a pullback. Either one of those is what I'm watching. But apart from that is myself on the pound. Let's move on to the euro now. So the euro, let's have a quick little look at what we've got going on this week in terms of news. Obviously, as you know, we do have the ECB and ECB on Thursday, but tomorrow we do have CPI. So hopefully CPI can sort of, as long as it stays around here, that should be fine. Obviously, we don't want it to come quite a bit lower, because that means, maybe the ECB in the future might have to be a little bit more dovish, which would not be good for the euro. But as long as it stays around the sort of these figures, that should look pretty good. Nevertheless, as we spoke about earlier, the ECB are not expected to do anything. So all we're going to have to build on then is what is mentioned in the statement. So are there any changes to forecasts, any changes to languages, etc.? And of course, what Lagarde says in the press conference, and sort of how she answers these questions, of course, will also be important. Nevertheless, euro-wise, I just want to say, I don't think anything here is going to be of interest. Yeah, nothing now of interest. I'm just double checking just to see. Now, latest FX dynamics and energy prices help the ECB stay in a good place. And as you know, obviously, high oil or gas is obviously going to be quite bad for the euro, or for Europe in general, given that they are one of the largest importers of said commodities. So as long as we don't see Iran and the US go ham at each other, then oil prices should stay relatively stable. As long as that happens, that should be somewhat good for the euro, as long as we don't see major issues. But risk sentiment is bolstered by a tentative de-escalation of the Middle East tensions over the weekend, which led to a further slide in energy prices. So that's good. We think ECB could be a little bit more relaxed going into Thursday's meeting. And if the calm lasts, generally speaking, the good place is looking at less comfortable, though, as the volatility over the past weeks has shown, a more dovish leaning and cautious ECB could already prepare the eventualities in March. This is something that the press conference could reveal on Thursday. So like I said, all we have to do is just watch what Lagarde says, how she says it, and if there's anything of importance. And if the euro strengthens further, the chances of a cut in March would increase. Remember, a stronger currency is deflationary, right? Because what it means is other countries out there who are losing value against the euro may not want to buy as much goods, right? And that creates deflationary pressures over time as well. So that's generally something of caution. It impacts a lot on Japan, though, as you may have seen. When the yen weakens off quite a lot, you do tend to see inflation move in Japan, and vice versa. When it strengthens, you do also see it come off a bit. So that's generally why they're always talking about the currency exchange rate, because it does impact inflationary pressures as well. And for now, the central bank will stay in a good place, and we don't expect Lagarde to say anything more on the exchange rate, beyond noting that the ECB will obviously monitor it closely. However, if the latest trend continues, and if the ECB wants to send a signal that a slight undershoot of inflation is as much a concern as a slight overshoot, the chances of rate cut in March would clearly increase, basically adding more volatility around inflationary data, right? If they stress a certain data to watch, then you are going to see more volatility around said data, right? Similar to when Powell mentions a lot, or we did previously mention a lot on NFP figures and growth figures. employment figures. So there was less volatility around inflation, but more volatility around growth and employment, because that's what they stress the most to watch. And again, that's kind of how you play the central bank meetings, right? Depends what they say. If they say anything in particular, the need to watch, then markets increase the volatility around those meetings, or the more, I don't want to say in volatility, obviously, but I want to say more importance around said meetings. But yeah, apart from that, I haven't got much else to add on to the euro. GS not really saying much. Euro, JPM not really saying much either. Again, we're going to have to see what they say, really. Yeah, JPM just says, not expected meeting this week, expected to be a non-event, prospective clearly language statement, and Q&A will be closely monitored. That's all they said about the ECB meeting. There's no expected fireworks to be, lit off at this meeting. There's just no need for it. As a result, we're probably not going to see too much volatility around the meeting, unless she says something crazy, but nobody's really expecting that. So yeah, price action wise, Euro, as you know, I'd still probably want to be selling this. Australia's a lot better off recently. So how do we get in? Well, as you know, you're going to have to obviously wait for a pullback because you don't want to be selling at lows. But keep price action very, very simple. Keep your technicals very simple. So basically what I'll be watching is a pullback into 69 and then a nice push to the downside. If not, that's perfectly okay. We just think, okay, where's the next supply zone or area of interest? And we can see roughly around sort of this 7,500 region. Anywhere within there would look pretty good. EuroCAD, I'll leave alone. Price action is very ugly. Euro GBP, similarly, I'm actually kind of surprised it sold off as much, but we spoke about it last week. Probably best to leave it alone until we see something. Euro Yen, I am not looking at. Euro New Zealand, we are looking for sales. So we do obviously have New Zealand data. I think it's Friday. So as long as that stays pretty steady, Euro New Zealand should sell off a little bit further, similar to like GN as well. AN is actually kind of steady, as you can see, because both countries are seeing a lot of good currency strength right now. So it's just best to leave those alone and go where there's of a better value. And right now there's more value in New Zealand than there is in Europe as of this currency pair. Europe is still seen as good. It's just that New Zealand's just got a lot more tailwinds right now. So we're looking to trade those tailwinds basically. And similarly, it's actually kind of similar to Euro AUD basically. You're just going to have to wait for that pullback towards 96,500 into these lows, and then monitor price action, how that reacts. Now, lastly, Euro USD, let's see. I mean, we are at a significant high right now at 1800, right? We're right at 1800. So the issue for me right now is I haven't got a lot of big reasons to jump into bearish dollar, meaning we need you'll just notice over time that there's events that occur and news that comes out where people really jump on board it. And right now we just haven't got that for the US. So I'm more inclined to be more bearish euro dollar for the time being as a tactical trade than bullish. So basically a push down towards 17, and then we can see how fundamentals is at, or data or sentiment, whatever, is at that time. Let me just move this over. Okay. Yeah, around there looks pretty good for me. Around 117. So yeah, apart from that, that's myself in all three currencies. A bit more volatility coming through, which is obviously nice in terms of a bit more news, which is good to see because we've been in a bit of a rut recently in terms of data because people haven't really been focusing on it. So data's been more backseat driving, but now it's coming to a bit more in the forefront now. So hopefully we can capture some decent trades. But nonetheless, that is myself on all three currencies. And let's move on to the AUD, the NZD, and of course the CAD. So the AUD, CAD, and of course the NZD. Right, let's start off with obviously the AUD because that's kind of where the most of this section of the breakdown is obviously going to be because there's been more news about it. We spoke about it last week. Obviously, they were expected a hike, so that wasn't new, right? That wasn't new. However, what we have to think then is what is the language, right? Is the language hawkish? Is it dovish? Is it neutral? Which one was it? And from what I'm seeing online and what they said, it seems as if they were a little bit hawkish. And as a result, the AUD has done pretty well. It's pulling back a little bit now, but that's perfectly fine. Generally what happens after meetings, it moves and then there's a little bit of profit taken and then it continues in its direction. So that's normal price action. So let's have a little look then as to what was mentioned in the meeting. So if I show you this one over here, and you can see GN, pound New Zealand dollar, downtrend sharpened by the RBA. And by the RBA, but that's fine. The Australian dollar, so let me just open this up in a new tab. The Australian dollar is benefiting Tuesday's interest rate rise, which was accompanied by more hawkish than expected message. Policymakers highlighted strong demand conditions and left the door open to further increases, noting that previously flagged external headwinds have yet to materialize. The Australian dollar stellar 2026 was fueled by a central bank, which was not only raised interest rates, but also pointed to prospect of further such moves. And again, markets like that confirmation, shall we say, of that they may need to hike again if necessary. And how do we know if they need to hike again if necessary? By what? By monitoring the data. That's all we're doing. Now, what then we do is that, okay, they expect potentially another hike if need be. Does the data now suggest a hike from here onwards, right? Do we see strong employment? Do we see strong and sticky inflation? If that's the case, that increases the probability of another rate hike. The economist warned of yet another hike, observing the RBA is clearly concerned about domestic demand, while saying negative developments overseas have yet to fail to dampen domestic activity. So they're talking about tariffs, China, etc. A hawkish hike describes, and we know what a hawkish hike is, some of the increase in inflation reflects greater capacity pressures as a result, and the board considers that inflation is likely to remain above target for some time. Uncertainty in the global economy remains significant, but so far, there has been little or no depressing effect on the Australian economy. Indeed, recent growth and trade in Australia's major trader partners have surprised on the upside. So China's done pretty well recently, as I'm sure you know. Over the past few weeks, it's done pretty decently, especially the currency as well. Obviously benefiting on the back of a lot of the stress in the US, right, caused by Trump, of course. We suspect the RBA may end up pleasantly surprised on the inflation front. We also think that a likely slowing in real household income growth, the current low level of consumer confidence, and today's rate hike will see weaker consumer spending growth. That's technically what does happen on a rate hike, obviously, but it does take time, right? Remember, that would take 6 to 12 months to even start to see it in the data. So it's not like you're hiking and now you're trying to sell the currency. It's that possibly in the future, we may see less growth or less spending growth on a rate rise. That's, as you know, all generally what happens. However, the risks are clearly skewed to additional hike, though, given the RBA's focus on capacity being behind the second half of 2025 lift in inflation. With no immediate data releases, the challenge narrative, the Australian dollar will hold on to its positive momentum. That is true. So obviously right now, we're seeing some pullbacks. And that's all I wanted to mention about the RBA. They're seeing quite a nice amount of hawkish behavior, a lot of hawkish language. And that just allows the currency to hold on to its strength as well. It's not like they hiked and then they were, maybe we're not going to hike anymore. We will see what's going on. They said, we'll hike again if necessary. And the fact that Australia's data has done pretty well over the past few months just basically increases that probability that we may see an additional hike. And the markets like that possibility of another additional hike. And that's what they're going to trade for the future. And then if data suggests otherwise and we don't see a hike, then sure, we'll see a bit of a sell-off in the AED. But until then, the AED should remain strong, right, on that possibility. And that's what markets like. Similar to like the dollar narrative, right? If we don't see any major issues in the US data, how likely is the dollar going to really sell off? Not very likely until we see that data. And it's similar to the Australian dollar as well. So what we can see then, and what we should be doing, is just pairing the Australian dollar against those who are a little bit worse off. So right now, like the UK, so GN, and I guess I can pair the NZD in here as well. Obviously, we do have data on Friday. That's fine. We'll watch that. Hopefully, it stays pretty good. But the New Zealand dollar also sees a benefit when the Australian dollar or when the RBA hikes rates, right? Just due to regional things, similar to like when the US does something, Canada does also slightly benefit it on the crosses. And it's similar for New Zealand as well. As New Zealand's data actually is not terrible. And I just wanted to show you this article about the Kiwi dollar draws European funds betting on an economic rebound. And obviously this Friday's data, which if I quickly show you, CAD. and New Zealand. And you can see that this Friday's data, was it this? Oh, no, so this evening's data, sorry, I was thinking about Canada. This evening's data should hopefully reinforce that the economy is doing okay. And it's recovering, and markets will like that recovery phase, because what happens is that it generally would then mean that they are at the possibility of maybe a hike a lot sooner than later, right? Because a lot of the other countries out there, like the UK, like the US, all are still looking to cut further, right? Possibly Europe, but they're looking to cut further, whereas these guys have already cut it a lot more aggressive and a lot earlier. So they don't have that buffer to cut further unless the data is really, really weak. And the fact that the data hasn't been weak suggests that they are starting to recover. And that's what we want to be jumping on board, is that recovery phase, right? If I show us business cycle in economics, right? This is the cycle, and we always go through this. It's pretty much guaranteed to always go through this cycle, right? Peak 2022, 2023, inflation peak. We're in the contraction phase or the slowdown phase. Basically, New Zealand's down here. And what you would have noticed, and they're possibly expanding a lot earlier whilst other people are still in contraction. And that's when you're trading that divergence between New Zealand's starting to expand and other people are still in that contraction phase, right? The data's not great. The employment is not really recovering and doing quite well. It's quite, it doesn't have to be weak, but it's very meh, right? And New Zealand's starting to slowly recover. And that's where you can get that opportunity and trade that opportunity. So it's not like you're late to the trade because it's already moved a lot. Think about what happened. If I show you GN as a good example, like on the daily time frame, this was a real big issue for New Zealand. The data was really, really poor. The central bank was cutting super aggressively, and they've done that really. So they went through that pain for a year and a bit, whereas now they're starting to recover, which suggests that they can now start to strengthen soon. Doesn't mean that they're going to sell off all the way down here, but what it basically means is that the reason its currency went so weak is because of issues in the data and really dovish central bank. But that's not expected to happen anymore. So does it make sense for the currency to be this weak anymore? No. So you're trading that rebalance phase, and that's the expansion part. And it could possibly go, we don't know, because we don't know what the data is going to be like in a year's time. But we basically just trade what we're seeing and what we are expected to see based on what we know right now. So that's a little quick summary of New Zealand. We're just going to have to see what today's data points. Hopefully it does well, and that reinforces the idea that the currency can do pretty well, and the central bank should remain a little bit more hawkish, similar to New Zealand. So that's why AN is kind of consolidated, right? Because both currencies are very, very strong right now. So there's no divergence there. Whereas if you look at like NZD JPY, there is a clear divergence. If you look at NZD GN, there's a clear divergence. NZD USD, there's a clear divergence. So you get the gist, right? That's what you want to be trading, is those pure divergences. In regards to CAD, we haven't got anything until Thursday, Friday, I guess. I don't think the data is going to be super amazing though. And I would rather be looking at AUD CAD upside, NZD CAD upside. I think those have the highest probabilities, in my opinion, to continue in their direction. There's other nuances out there like EuroCAD and ECB talking, and then that could drive EuroCAD. But we don't want to be trading pairs, right, where we're constantly having to always think about something. We want to be in a trade, or for example, 1 week is this issue, and then it happens possibly again next week, and then something can change, and now suddenly it's strong again. We want to be in trades where we don't have to worry about those sort of things very often, like New Zealand dollar CAD. There's not things that we have to think where we're like, oh, maybe there's some issues in New Zealand and this trade won't go into play. We don't see that issue, right? Similar to AUD CAD as well. There's a lot of positivity. There's nothing on the horizon that would point to weaker AUD that we have to consider when we enter a trade. We want to be in trades where it just makes a lot of sense to be in, rather than trying to chop and change. We don't want to be in those trades. So with Canada, I would rather be bearish against AUD and the New Zealand dollar. And other ones out there is a bit more choppy, so I'll leave them alone, if that makes sense. Like, that's why we've left EuroCAD alone. GCAD as well is best to leave alone, whereas the other ones, there's opportunity there. So that's a very quick summary on Canada, and there's nothing else to add on to that. It does appetize me, as I've spoken about over the past couple of weeks now, apart from the two that I've just mentioned, ACAD and NCAD. In regards to the yen, this week, you can see data is pretty dead. So if I show you, so we haven't got anything this week. Next week, we have the elections. And think about the reason why the yen was strengthened initially. So like, for example, dollar yen and all that big sell-off that we saw or the strength in the yen, right? Was it because of fundamentals, or was it because of positioning? And in my opinion, it's due to positioning and also a bit of the USD as well, which also does help the yen. However, has fundamentals pointed to the yen being strong? I.e., have we seen really hawkish BOJ? Or have we seen positivity in the elections or positivity in politics? No, we haven't. Those are the reasons why this was so weak in the first place. That hasn't changed. So it doesn't make sense for the yen to continue to strengthen until we see, more so the elections, in my opinion, be favorable for the yen to do well. And that's why we spoke about this last week, on last week's breakdowns, about even though it sold off, dollar yen, AED, JPY, etc., New Zealand dollar yen, GJ, it doesn't make sense for those trades to continue to sell off because there's no fundamental backing behind why it should continue to sell off. And AED yen has continued to rally. And that's the one that I posted in the Discord from here. We've done quite a decent amount of move there. So just keep trades simple. Don't try and overcomplicate trades, right? Keep it very, very simple. Don't try and think about different angles that you can try and trade through. Only follow what the markets are caring about right now. And right now, they are caring about the elections in Japan. The elections are negative for the yen. So therefore, we can't buy the yen or sell AUD JPY or sell dollar yen or sell GJ until we have a fundamental reasoning. And I think Bloomberg, I did see an article on Bloomberg actually, which was this one about Techncial saying wasn't emphasizing weak yen merit. And they said, Katayama said Prime Minister Sanai Techncial wasn't overly highlighting the benefits of weak yen. Katayama agreed with Techncial's stance that a weak yen has both pros and cons, which is generally true for every currency, and traders are bracing for increased volatility as the elections on the 8th, betting that Techncial's Liberal Democratic Party is likely to secure a sweeping victory. If that's the case, Techncial is kind of more on the Abenomics front, so basically she is very inclined to pump loads of fiscal stimulus out, wanting to not raise rates because that's counterproductive to what she wants to do. So that's why there is a possibility that the yen may not have a reasoning from politics front. If that's the case, is there a reason to buy the yen? No, of course not. And that's what we focus on. In regards to the Swiss, think about, again, similar to the yen, think about the reason why the Swiss was so strong in the first place. For example, if you look at CAD Swiss, why did it sell off so much? Because of increased volatility around Trump and gold rallying quite high, obviously, because of volatility and politics, etc., and what it means for the US economy. As a result, the Swiss saw a lot of safe haven buying. That's perfectly fine. Are we seeing that right now, though? I would say not. So I do feel like we could probably just come a little bit higher on CAD Swiss, and Swiss to come in lower basically across the board, because we're not seeing that increased volatility that was creating the strength in the first place in the Swiss, right? Always think opposite to your trade, and then that gives you a guidance on whether or not we are actually going to see a pullback or not. So right now, I would say yes, probably we are going to see a pullback. I don't think we're going to push really, really strong, but I do feel like we can probably just reverse a lot of the gains that we saw and then stabilize and see what happens at that point. We will see again what happens at that point. But right now, obviously data-wise, you can see that Swiss front, there's nothing here. So again, next week, do we have anything? The elections and then CPI. CPI has not really been a major factor for the Swiss. People aren't really looking at, because if that's the case, you would massively selling Swiss. But it's just the fact that we're in a bit of a sticky environment. that the Swiss hasn't been inclined to sell off much because people don't want to be overly bearish the currency and then suddenly go super bullish the currency. So they'd rather stay more neutral. As a result, they've just purely been following risk sentiment, and risk sentiment improves. The Swiss weakens off, and then if something comes in, then they strengthen the Swiss. That's all you have to follow. So yeah, I do feel like we could probably pull back a bit now on the Swiss. That G Swiss comes in a bit higher. AUD Swiss, I don't trade it, but that would make sense for a nice push. NZD Swiss, I don't trade it, but it would make sense for it to push, right? Lastly, gold. Now, gold is interesting because we've actually now started to break this lower high that we spoke about at the start of the breakdown. Obviously, the difference between Swiss and gold is seen as that better hedge against issues in the world, right? As a result, we now have to ask ourselves, are these issues really going to fade away anytime soon? Probably not. So if gold does probably still look a bit higher, Swiss only benefits when there's real big issues in your face very, very quickly and very aggressively. Then Swiss sees a lot of benefits. But if there's a possibility of something happening, gold sees upside as well, more upside than Swiss, right? You're seeing like G Swiss push, but gold push. That doesn't make sense from a correlation perspective. So for me, I think gold is the much better trade to take right now on the back of like issues in the US in the future, possibility of Trump talking again. Iran is also another possibility, although it has slightly died down a little bit. There's still that possibility. So gold is still seen as that positive hedge. So no, everybody, that is myself. So what I want to see basically is a nice closure above this high, and then we can get a pullback, possibly towards these highs here, and then a nice push to the up. So I'm not going to trade it all the way into all-time highs yet. I'm just going to be quite conservative. Just trade it to this high, and then this higher, and then this higher. But yeah, apart from that, everybody, that is myself for today. I appreciate you all for being here, and of course, see you on Friday. Let's just see if anything does happen from the ECB, hopefully, and of course the BOE. And then obviously we will take some trades accordingly on that assumption. But yeah, apart from that, everybody, have a good rest of your week, and I'll of course see you on Friday. Take care.